Today we went to the Gainesville Innovation Summit, and one of the founders of the Florida Funders Fund announced, or he promised us information and data on quarterly reports for startups, and that's something that we're going to incorporate into the newsletter, as we get that information and data. So that's just another bonus being subscribed to this newsletter.
Yeah, so if you guys want to stay in tune with VC and the buy side, we're going to start showing you the quarterly results straight from Facebook, but we're going to summarize it nicely for you guys in a nice synopsis in our newsletter. Yeah. So today we went to the Gainesville Innovation Summit, and everybody who went today could tell you that it was a fantastic event. The guest speakers that we got to see, some were entrepreneurs, some were VCs, some management executives. Probably one of my favorites was the CEO of Cameo and the CEO of Better. Their stories were just crazy, and honestly probably one of the most intelligent founders I've seen in person. But yeah, we made a lot of good connections, a lot of promising projects for you guys in the future. But yeah, happy to answer any questions if you guys were interested, or we're going to be doing more things like this, so don't think that it's just limited to this. We want to do a big field trip next semester. We're trying to do one this semester, still trying to gauge the interest from other parties to see if we'd be able to visit. The next semester, for sure, we're going to do a big trip either to Miami or to the West Coast, so stay tuned for that.
For reference, Better's the company that Jake Paul's starting, the sports betting company that's just getting a lot of buzz in that industry. So it was really interesting to hear about that today.
What was the valuation?
$300 million, and they've made $60,000 in profit in the last month. So it's really not a big company, and how much they're actually making in profit, but we'll see how it goes for them. They're valued very high, and they have a big chance for the market share, especially with the market cap increasing as the U.S. continues to make sports gambling more readily available.
Yeah, and some updates. Sorry I didn't get to update this slide, got really busy today, but I can kind of give you a quick synopsis of everything. We didn't go to Alchemy Club this week. UF Innovate, I think we had a meeting yesterday for Project Horizon. It was pretty good.
Yeah, we have some steady inflow from the biotech connections we have at UF Innovate. Donations, we're going to be paired with those projects, which is really exciting for the club. When we talk about trips, socials, they're starting to pour in more and more, which is really exciting from these projects. So yeah, the degree of seriousness is definitely increasing, and we have more inflow coming in from UF Innovate as well.
Yeah. Competition team is working hard on the seed competition too. If anybody's interested in pitching, reach out to Abhishek or the competition team. And that's it for updates this week. The dashboard is pretty much the same from last week. No new updates there. If anybody's new, this is basically the dashboard where we try to show you guys everything we've done thus far, what we have in the future, and what we're doing right now. What I will probably say is that VCIC planning is definitely kicking into high gear now. We're doing a lot of planning, and we've actually conversated with a lot of people today who basically verbally committed to being judges. We got some heavy hitters, and the OneSixOne, the venture fund that actually hosted Gainesville Innovation Summit today, actually committed to helping us out in any way that we need. Probably for the reception that we're going to do, we're bringing a lot of venture capitalists and buy-side professionals to come. A lot of schools are coming, like Georgia Tech, Georgetown, Emory, Dartmouth. I remember correctly, American University. Some cool universities are coming on campus, and it's going to be a good networking session. But that's the only thing I moved to the middle. Yeah, and that inbound from UF Innovate, the meeting is scheduled for October 24th. So for anybody who applies to the advisory program, stay in tune. And quickly, I want to say something about the advisory program. We got everybody's applications. We're currently reviewing that right now. If you're wondering how we already have a project underway, it's because we already made calls to some analysts. But we want to let you guys know that within, not next Monday, but the Monday after, if you apply as an analyst, you will know if you'll be in the advisory competition marketing program. So just a heads up there. So let's get into it.
So last week we finished up the evaluation stuff. This week it's a little bit lighter, it's starting a fund. So what is a fund? An investment fund is a collection of money from different individuals and entities that attempts to generate a return for different investment vehicles. This sort of fund structure is not simply relegated to investment funds. There's a lot of different fund structures that exist. So these are, of course, investment funds, which includes your typical private equity, your mutual funds, which are investment funds that pool a bunch of different money to buy different securities, venture capital funds and hedge funds. You also have pension funds where employees or employers will pool money together to try and supplement retirement income. You'll have insurance funds where the insurance companies will take the monthly premiums from the insurance policies, and then they're going to invest that in different assets, so that the cash flow generated from those assets and the returns can cover the insurance payouts. You're going to have sovereign wealth funds, and this is the kind of investment arm with different government entities. And then these government entities are going to get money from trade surpluses, central bank cash reserves, exports, and then government payments. So like if on a government budget you run a surplus, the government will have an investment structure set up where they can invest that extra money. You can have endowment funds, like UF's endowment funds, which is money set aside by donors for a specific purpose, according to the will of the people who fund the endowment. And so, for instance, UF's endowment funds would be to go towards research grants, building halls like the one that we're in right now, building student housing facilities. And you also have trust funds, which is money that's specifically set aside for beneficiaries. Some key terms to understand when you're looking at funds is your GP, your general partner, and your sponsor, your limited partner. What is a limited partnership? And then this concept of carried interest. So your GP is going to be the smaller entity in a fund. So a fund is going to be set up, and we're going to have a graph that explains this, where there's a GP and there's an LP. So the GP are the people that are actually on the day-to-day managing the fund, and the LP are the people that are giving them the money. So if an investment fund is a collection of money from different individuals, all those different entities that are investing into the fund are the LPs. And the GP is the entity that's responsible for allocating that money accordingly. And the way that they're paired together is through what's known as a limited partnership. So a limited partnership is a special kind of general partnership in which you have one GP and you have more than one LP. How it works is the GP has unlimited liability and the LPs have limited liability. And then you have this concept of carried interest. So carried interest is the incentive for the GP to reduce the LP a certain return level. So if the GP hits, say, a 10% IRR, then they're going to earn a carried interest amount, which is going to be higher than the proportion of equity in the actual fund itself.
For example, a general partner would be like a hedge fund, and then the limited partner would be the endowment. So the UF endowment would give them money, and then the hedge fund would actually be working with that money.
Right. The GP would be the people that are in the hedge fund on the day-to-day actually making investments. The LP would be the investors in that hedge fund. Here we have some examples for you of kind of some of these different fund structures. So this is actually the state of Florida's kind of sovereign wealth fund arm. So when you're a public Florida employee, the state of Florida matches a percentage of your salary, and it gives it to what's known as the Florida State Board of Administration. The Florida SBA is responsible for investing that money. So they hold a lot of different assets. They hold assets in real estate, they have bonds, they have equities, and a lot of the pension money, the retirement money that comes to Florida employees when they retire comes from the investments made by this. And they're investment professionals working for the state that allocate all of those resources. This bank here, this is the Sovereign Wealth Fund for Norway, and this is Abu Dhabi's investment authority. Now the United States doesn't have a sovereign wealth fund with which they invest capital, but different certain states do. So the SBA isn't here because this is considered more of like a pension fund, but you can see 11 US states actually have these fund structures set up. You can see the origin. So a lot of these funds are made possible because of money gained to these state governments by exporting petroleum.
I know, coming from Texas, the petroleum is all from the Permian Basin, and that Permian University Fund, actually a third of it goes to A&M, and then 2/3 go to Texas, and the rest of it doesn't go to any of the other public universities, and that's something that's changing currently in their state legislation. Just random fun facts for the day. But And now we're going on to fund structures. So you have your private equity firm, so that's the general partner that's going to be managing your day-to-day. And then you have your limited partners, the investors, as we were talking about. So that's the pension fund, which is different funds that are feeding money into the private equity firms. So they choose where they invest and which firms they decide to give money to based on their credibility and their return rates in the past. And this will go into their private equity funds. So today we met with the OneSixOne fund, which recently started in Gainesville from University of Florida students, and they have $1.5 million in their funds that they've been investing. And then they'll just put that money into different investments. They're currently invested in 11 different companies. I think the majority are in the Gainesville area, one of which those companies is Better, which is based out of Miami. And then the private equity bond structure. So you have, again, your investors and then your financial sponsors. So you have the management and then the general partner. And they'll just contribute to different investments, trying to better those companies. So the funds will just try to increase the valuation of those companies and their actual value that those companies are generating, the business that they're able to accomplish, so that their investment grows.
Right, so when we look here, if you just follow this graph, the investors for the LPs are going to provide the capital that most of the money that goes into this private equity fund is going to be able to deploy. With that capital that the investors provide, they're going to buy all these portfolio companies pursuant to whatever investment strategy they sold these investors on. And then the GP, who is this management company, is and GBM the same. They're going to earn those carried interest if they can provide a return, an adequate return to the private to these investors. They also, in some cases, will make management fees. And that's kind of a similar structure showed out here, where whatever investments these are made by the investors who do have ownership of the fund, and then the private equity firm is the general partner here.
Now, kind of the most complicated concept to understand when you're looking at fund structures is what an actual carried interest is, and there's kind of some jargon here that we need to go over. So the first is this 8% prep. So how this is going to work is the LPs and the GPs are both in it for the profits. They're in it for the returns on the investments that the fund makes. But then when it's actually time to distribute that money, there needs to be a structure that both parties think is fair in terms of who gets what and when. So how things typically work, and this is a very simplified version of it, is you're going to have your pref return. This is known as the preferred return. And this is a return that the LPs are going to get first before anything else. So what's not shown here is return of capital, which you're going to see in other graphs that we're going to show you. But for right now, just think about it like this. The LPs are investing a certain amount of money that goes into the fund, and once they hit 8% cash on cash, so once the fund returns 8%, all of that 8% is going to the LPs as their preferred return. Then what will typically happen is there's going to be a catch-up. So in this instance, there's a 2% general partner catch-up. So the next 2% of profits that the fund generates are going to go straight to the GP. So that's kind of, after the LP investors are satisfied, they've made their 8%, they're going to say, okay, we'll let the GP have a little fun, the GP can get a little 2%. Then after that 2%, that catch-up is satisfied, they're going to have an 80-20 split on profits. And this is typically how it's going to work is they're going to split cash flows up until a certain promote threshold. So in this instance, they're going to have an 80-20 split on profits from 10% cash on cash on the fund to 20% cash on cash on the fund. In which case, in this instance, the fund returns 24%. After this 20% promote is reached, the returns that the GP gets jumps up, and now there's a 50-50 split, as opposed to an 80-20 split on profits. We can see here, adding this up, the LP gets 8% on their pref, then they wait it out a little bit, they make 80% of this of these 20 percentage points, which is another 8%, and then they're going to get 50-50 on this additional 4% profits, which adds up to 18. Does anybody want to count the percent that the GP made? Yes.
That's 6%.
The GP made 6%. Now you might think to yourself, okay, why would the GP go through all this headache just to make 6%? Well, the GP is not making 6% in isolation, or they're not making 6% on the equity that they put in. They're making 6% on the fund. So what you're going to see is the LPs, they're going to let 3x their money. The GPs, relative to the equity that they put in, the fact that they can make 6% on the fund, they're going to 10x, 11x their money. And that's why it's very lucrative to be in this career, and that's why
GPs, private equity companies, make a lot of money.
The 8% return, that's the typical index for a stock account, so that's why you have the 8% first, and it's not split with the GP as well, because they're expecting to get that no matter what.
And kind of show it a different way. This is showing that equity waterfall when it's time to actually distribute the cash flows of the fund. So here you see there's preferred return of 8%, and then there's a return of capital. So this is typically kind of connected. Then you're gonna have that GP catch up, and then until capital is returned, and then the preferred return is reached, the cash flows are split up pari passu, which is typical. Which is in this case, the GP put in 10% of the entire money to actually get the fund going, and the LPs put in 90%. So while there's a preferred return and there's return of capital, they're going to get that cash flow in pari passu until there's a catch up, which is 25% GP profit, in which the GP is going to get 100% of the cash flows. Kind of just ignore this notation for now, the 25%. Then there's a carried interest / promote. So upon a 13% IRR, there's going to be a promote structure in which LPs get 63% and GPs get 37%. You can see over 13% IRR, that's when that promote kicks in. And then so once they hit that 13% threshold, LPs are going to make 54% of the cash flow and GPs are going to make 46%. The reason why it's set up like this is because it incentivizes the GPs to actually produce a good return. Because although that when they're over 13% IRR, LPs aren't making as much money on every dollar that the fund is returning, it's better than if they had made a 12% IRR and they were stuck up here. So this incentivizes good performance on behalf of GPs, and private equity companies make most of their money by hitting these promote thresholds, or at least hitting the catch-up. And this is this kind of structure shown on Excel, and we're actually going to jump off of PowerPoint and show this made off screen. But here you can see 95% of the money that's going into this fund is from the LP, 5% is from the GP. So total capital invested is $500,000, and then the preferred return is 8%. So the value of the preferred return over 5 years is going to be this amount here. The total investment proceeds from the $500,000 or $1,500,000. You can see this waterfall work out and how the cash flows are split, where they're pari passu when there's the return of capital until the pref return, and then the GP catches up and the GP gets this cash flow and the LP gets nothing. Then there's an LP GP split after the cash flow amount, resulting in the cash flow figures that you see here. And again, why do people want to be fund managers? Yeah.
Because it's highly lucrative. I mean, they're like, yeah, that could be for a small fund, but when you're looking at these humongous PE funds with like $500 million, $1 billion, the 2% return is, I think, like what, 20 mil?
Exactly. So kind of taking a step back from all the minutia of like how these specific figures are calculated. If you just understand the structure of why things are going on, then you'll be okay. There's a return of capital until there's a preferred return hit by the LPs. Then the GPs catch up for a little bit until there's a point at which the catch-up ends and there's an LP-GP split. Typically, there's going to be a step 4 where this proportion that goes to the LPs and the proportion that goes to the GPs is going to become even more weighted in the GP's favor just to incentivize them hitting another IRR threshold. But what's important to understand is this. The LPs are putting in $475,000. They're walking away from this with $1,235,000. So cash on cash return, they're like 3xing their money. The GPs, on the other hand, are putting in $25,000. But because of this promote structure, they're walking away with $265,000. So they're 12xing their money when the LPs are only 3xing their money. Granted, it comes with a lot of risk, and you have to get to a certain point where you can convince people to give you $475,000 for the equity to invest. But this is why private equity is so lucrative.
But what's the point of the GP catch-up? Like, why didn't that just get added to like the 80-20 split?
Yeah, that's a really good question. I guess that's just kind of how the market is. Like, market dynamics kind of determine, because you have to think like, this is how I would answer that question. What funds are competing with other funds for those investment opportunities. So I guess just because of the competitive environment, this is just what LPs and GPs have come together as like market participants to agree is fair. So other funds, if they want to be more competitive for investors' dollars, might say, okay, there's no catch-up, or the catch-up might be less. I don't know specifically why they don't just add it to like the LPGP split and just like change the tiers of those proportions differently. Like I said, the market participants that came together in this equation and said, okay, LPs are going to make their preferred return and cash flows are going to split up pari passu. Then GPs can kind of go in and make their kill. But I suppose when you think about it practically, it kind of is like a security mechanism for the GPs, because I don't know if the GPs could like survive if all that they made was their pari passu amount of the cash flows up until the LPs hit their preferred return. Like there's probably like, okay, once the LPs are taken care of at that pref, which is probably like the minimum acceptable return the LPs will take, then we can let the GPs like be able to like fund their business, like pay their employees. This is when the GPs can really like have some cash flow for like their operating expenses. And then once we get into actually those high return metrics, then the GPs can start to really make some profits. If that makes sense.
The first 10% is probably their expected return minimum, so that's where they're covering their own expenses, and then past that is where they're profiting.
And the second question would be like, are you stretching or?
I will rest it. You can go if you have something.
No, my quick question would also just be like, how does it work out if they don't hit pref return? Like, because it's a very risky industry.
So that's where they're looking at the limited liability, and they wouldn't be, or the general partners would be more liable for the loss than limited partners.
Oh, so when they make money, GPs make more money, but when they lose money, LPs lose less money.
Yeah. Gotcha. If LPs, I mean, if they don't make their pref return, like as a fund, you're doing really bad, right? And like, this is part of like having a track record, and the people who are in these management positions who are pitching to investors, they're not in that position for no reason. So if you're not hitting your pref, like that's really bad, and you're probably not going to convince someone to give you money to invest with ever again. So I would say that unless there's some like macroeconomic event, like I'm sure during GFC, during COVID, a lot of funds probably weren't returning adequate returns to their investors, but that's very hard to come back from it. Obviously, as an LP, that's part of your job, just doing your due diligence to the management team, understanding what the investment strategy is, and yeah, some investments don't work out.
In this example, it mentions the hold period is 5 years. What would you say is like common or average hold periods of just like the whole thing to run its course?
Yeah, that's a really good question. It really depends on like the type of asset. Like I know in real estate, depending on the type of fund and the assets they invest in, like the hold period can be 2 to 3 years or it could be 10. So it really just depends. Like when you're talking about like pension funds and you're talking about like sovereign wealth funds, their hold period is just varied across like the asset allocations. They might have real estate that they're disposing of in 5 years, 10 years. When you're talking about like insurance companies, they're worried about something called like asset liability matching. So they're going to have these liabilities with these insurance policies, and they need to structure their assets to kind of, they need to structure their assets so that the cash flow from the assets matches the cash outflows from paying out the insurance policies. And there's like a certain calculus with like, okay, which assets do I invest in that are going to give me cash flows that are going to mimic my my cash outflows, and like that's kind of like how banks work. Is they're gonna lend out the money that you put in, and then they lend out the money for interest, and then they make a spread on the interest that they pay you with your savings account, your savings deposits versus the interest that they lend to people, and then that they make.
I also know some hedge funds, if they see things wrong immediately with the company and they think they can fix it in 6 months and then double their investment, they can buy a company for $50 million, change a lot of the cost pricing, or the costs and the management, like rearrange management, and then double their money, and so then they sell a company. That comes with a buyout. It depends on it, like present value of money. It depends on if you're going to grow your money faster somewhere else, and that's when they'll pull out or not. I mean, granted, it's all estimates, but do the best that they can.
Yeah, I'm gonna get the screen off the screen. All right, so we're actually going to show you a video of someone actually walking through this model, just so that these concepts can kind of just stick more.
Making a $500 million thing that triples in value, that's what the distribution will call real fast to find out. So we're going to have a $500 million fund, and we're going to assume the sponsors invest 5% to skin the game. Next, we'll assume the investors are entitled to an 8% preferred return, and the whole period is 5 years. So let's find the capital invested by this 8% preferred return for a 5-year period. and subtract the original amount invested. That gives us the value of the preferred return. And it simply triples to $1.5 billion. Now, the private equity partners will get a performance fee or carried interest of 20% for all their work. And it's 20%? Where's our figure? Yeah, this one here. That's why most people want to go in private equity, and we're going to find out why. So let's get started. In a distribution waterfall, the investors have to get their capital back plus any preferred return before any carried interest can be earned. And we can confirm that there's enough cash in the investment proceeds to cover both the return of capital and the preferred return. So we're going to use the main function to compare total capital invested plus this preferred return in F17 and compare that to total proceeds in F21. And of course, we're just going to multiply that by a percentage below. Before we look at the percentages, I'll just quickly base this across, and then we can get to the pro rata contributions. Again, can't be earned until the steps, so this is just a zero. The next step is the catch-up, which goes entirely to the private equity firm in the form of carried interest. So we zero everything else out. We can move to the percentage for carried interest above, and next to the calculation of carry, we're going to again use the main function to make sure we have enough proceeds. So we're going to take total proceeds and then subtract distributions made so far. Next, we're going to calculate the value of the carry. So we're going to take the value of the preferred and divide by 80% or 1 minus 20%, same thing, and we subtract the value of the preferred. Now this is going to give us the value of the catch-up, and if finding it confusing, I have details on how this works on YouTube, but we don't have time in this quick build video. And it's much easier. We just need to calculate the 80-20 split between investors and the sponsor. So we just take the remaining proceeds and multiply by pro rata percentages. The only thing we're being mindful of is that now the investors will get 80% of the pie. So we're going to take what they contributed as a percentage and multiply that by 80%. And then we're just going to do the same thing for GP equity. So what we've effectively done is dilute the investors by the amount of carry, which we fill in here. So to calculate dollars, we're just going to take the proceeds remaining, subtract all distributions made to date, and we're going to do that for both steps, and then multiply by the percentage below. Copy the formula across, and we've completed step 3. And that step 2 is just about summing everything up. So there you have it. The private equity firm would make $200 million in carried interest, and the company invested would bring $65 million. Not bad.
Go to more, then quick hide. Floating view. F5. Top, it should say switch display preference, be up, take out, hide the floating windows. There you go.
Okay, cool. Sorry about that, guys. Anyway, I'm gonna go back to this screen. The key is really just understanding that process, understanding that there's a pref return that you guys have to hit, that the PE companies have to hit for the LPs, and there's a cash flow amount, and there's a split on profits until promote, and then that split goes more to the GP's favor. So how do you actually
Start your fund. So starting your fund, first you have to choose what investment strategy you're going to be taking. So what type of companies you want to be investing in. Biomedical tech, biotech, regular tech, if you're just looking at manufacturing. So just the general startups that you're looking to invest in or companies that you're looking at buying out. Then you would set up your fund's legal structure, and then you would find investors would find you to pitch. There's a lot of entrepreneurs that are looking for just cash to be raised, and they need money from VCs and private equity companies to do that, so they'll come to you. You just have to get your name out there, and
Step 2 is going to be set up your fund's legal structure, and step 3 is going to be pitch your investment strategy to investors.
Just gotta click this one right here.
So we have a couple of investment strategies that I'm going to show you guys from actual funds. So we're going to head off the PowerPoint and one on the other side. Yeah.
So this company is called Rialto, and this is actually the company that I'll be returning to when I start my full-time job. Next summer, I interned at this company last summer, and they operate off of a fund model. It's a real estate private equity company. And these are some of their investment strategies. They invest in commercial mortgage-backed securities, which is their biggest investment platform. They do direct lending on transitional properties. Here's just a bunch of real estate jargon, but they originate debt. And they also do a little bit of direct equity investment. This is another company, and this is more of like a hedge fund type of company, and it's kind of a similar thing here where they try to outline their investment strategy. Our international equity strategy dates back to 1991 and is utilized the same philosophy and process described below. Total, we manage approximately $20 billion across all international equity assets. You're gonna have your fund overview. It's gonna show your, it's gonna typically show your assets under management. It's gonna show your portfolio managers, your management team. So these are the people that are kind of the masterminds behind that investment strategy, trying to hit that promote return metric.
And that company is publicly traded as well. So the funds, if they get big enough, they have enough assets like Blackstone and Mondrian, then you can buy and sell their stocks.
Just kind of to show you more examples of how this works. This is Blackstone. This is Blackstone's private equity platform. You can see some of these figures here that kind of hark back to some of the other things we've been learning. They have $40 billion of available capital to invest. So this money is coming from investors who are just giving them, and also institutions, but LPs who are giving them this money and entrusting them with their various investment strategies across these 123 portfolio companies, which should be listed. Yeah, so these are some of the companies that they Emerging Climate Technologies, Bumble, Ancestry. Here's an example of a pension fund. This is the Pennsylvania pension fund.
So pension funds for whenever you're working for your retirement fund.
Right, so this is the snapshot. So Pennsylvania is going to contribute a certain amount of money as a percentage of their public employees' salaries, and they're going to put it into this fund. And you can see some of these figures here. Your average 2021 annuity, they're paying the repeat beneficiaries of this fund $25,000 per year, $30,000 per year for those who work to full retirement age. Total benefits paid is $3.7 billion. And the total fund assets as of December 31st, 2021 are $40.2 billion. So you can see even something that might seem as minute to us as the Pennsylvania State Employee Pension Fund has a good amount of capital left to employ, actually the same amount that Blackstone has left to employ right now. So these pension funds are very significant. And here's an interesting resource for you guys that I actually just discovered when I was designing this PowerPoint. It's called Top 1,000 Funds. And it's just a directory of basically like the top 1,000 funds in the world. And you can see some cool names here that kind of hark back some of the things we've been learning. The China Investment Corporation is the Chinese Sovereign Wealth Fund. Abu Dhabi Investment Authority is the investment authority of the United Arab Emirates. The International.
Japan has $3 billion.
Yeah.
Those top three, if you combine them, that's huge.
Yeah, the Japan Post Bank, and you can actually click on. It shows you the performance for those that are available.
Pension investment fund.
Where you see it. Yeah, true. Yeah, so we can click on this. It'll show you the asset allocation. So the people who are running the investments of the pension fund for Japan have decided that they're going to put 26% of their assets into domestic bonds, 44% of their capital in foreign bonds, and then domestic and foreign equities. And you can see some of these have different asset allocations. Let's look at the IMF. They don't have asset allocation information. Let's check the Chinese Investment Corporation. Okay, here we go. So 35% of the money of the resources available to the Chinese Investment Corporation is in public equity, 47% is in alternative assets. So that's going to be things like real estate, 2% are in cash products, and you have 15% in bonds.
China has the biggest real estate market, like 25% of per perspective. The U.S.'s real estate market's only 17%. That's probably why
Well, so that's a really good point. Yeah, China has the largest real estate market as a percentage of GDP. So China's real estate market is represents 25% of their GDP, and the U.S.'s real estate market represents 13%. I think I just discovered what I want to do for current events next week because that's very, very interesting. Okay, so back to the PowerPoint. Still working? Okay, sweet. So step 2, your legal structure. So your key considerations are going to be your registration with the state as a limited partnership, and your derivation of the fund's governing documents. So you're going to need to outline who has control, who specifically is the entity that's the GP, what is the management structure, what is the promote structure, so what are those thresholds that you have to hit in order to hit your promote, what is the preferred return structure, how much is the GP cash going to be, what are the cash flows proportions going to be with the distributions, how long will your fund last, that's also going to be outlined in the governing documents of the fund, and you're going to have capital raising compliance, exempt offerings, which basically just means your offerings are exempt from having to be disclosed to the SEC because these aren't public offerings, typically these are private offerings. And we have a kind of a funny clip for you from The Big Short, which kind of goes back to why having legal considerations is extremely important, both if you're a fund manager and especially if you're an investor in the fund. You need to understand what your rights are as an investor and who has control.
Okay, so we've got a file server and you have Microsoft 365. You want to get rid of that file server. Boom.
So here's some context. The Big Short takes place during the Great Financial Crisis, and what you're seeing right now is this individual here, Dr. Michael Burry. This is his hedge fund. So just like we've learned, a bunch of investors gave Scion, which is the name of this fund, a bunch of money to invest in. Although there's analysts at the fund and a lot of the jobs we're going to get are going to be in these kinds of positions, Dr. Michael Burry is the most important person in the fund. He's, at the end of the day, making the decisions as to where he's going to invest all these investors' money. Now, without getting into too many details about like the Big Short and what happened in the Great Financial Crisis, he is taking a financial position that at the time is not very popular, but ended up being extremely successful. And you're going to see what happens when the investors find out the position that he took.
No, you should prefer that you no confidence in the ability to identify macroeconomic trends. You're here to tell me that? Why? Anyone can see that there's a real estate bubble. Actually, no one can see a bubble. That's what makes it a bubble. That's dumb.
So what he means by bubble is he's saying anyone can see that there's a real estate bubble. Anyone can see that the price of real estate is inflated. That the price of real estate does not reflect the actual underlying asset value.
It's always marketers. Mortgage fraud has quintupled since 2000. The average take-home pay is flat, but home prices are soaring. That means the homes are dead, not assets.
So Mike Burry of San Jose, a guy who gets his hair cut at Supercuts and doesn't wear shoes, knows more than Alan Greenspan and Hank Paulson.
At the time, Alan Greenspan was the chairman of the Federal Reserve and Hank Paulson was the secretary of the Treasury. Those are very important people.
Dr. Yes, he does. That's cute. That's cute. Are you being sarcastic with us, Mike? Lawrence, I don't know how to be sarcastic. I don't know how to be funny. I don't know how to work people. I just know how to read numbers. How big's your short position right now? Just 1.3 billion. And the premiums? We pay roughly 80 to 90 million.
each year, which is, I was the first to do this trade. What?
So he took the investors' money and took a $1.3 billion short position on the U.S. housing market. Now, housing prices crashed, but these investors don't know that. All these investors know is that he took their money and shorted the housing market, which to this time was the most foolproof investment one can make. So they think he's crazy.
We'll pay. I may have been early, but I'm not wrong.
It's the same thing. It's the same thing, Mike.
You're managing a fund of, what, 555 million? In 6 years. It'll all be gone. On one bet.
The second quarter of '07 is when the adjustable rates kick in and the defaults will skyrocket.
Yeah, says you.
How much is eligible for withdrawal before they do, say in the next 2 quarters? If your investors panic.
302 million.
My God, Mike.
No one will pull out. That would be suicide, man. Down 17% for the year, but if they trust me and they trust me.
No one trusts you. No one.
Several emails to investors letting them know that the second quarter of '07 is when our housing positions show returns, and I've been very clear.
People will withdraw their money.
Watch that would be so stupid.
So he's talking about people withdrawing their money from the fund because they don't want Michael Burry shorting the housing market with the money that they put in.
If the fund's capital is dropped too much, then the swaps contracts are voided, and then the banks get to keep on.
Wait a minute, wait. The contracts are voided? The contracts are voided?
So obviously that investor was not that happy.
With HPE Greenlake,
that he invested in Michael Burry's fund. So actually in the movie and in real life, there is a legal stipulation where Michael Burry could lock down the fund's assets, so he did not let investors take out their capital. Well, obviously, there are going to be a bunch of lawsuits that come out of that. If this guy wants his $10 million back from the fund, and there's a stipulation in the way that this fund is set up legally that lets Michael Burry lock down that capital, that's obviously a problem for the investor who thinks Michael Burry's going nuts. Of course, Michael Burry made his fund a lot of money. But they didn't know that at the time. So that clip was just a funny kind of demonstration of why understanding the legal structure of your fund, both as the fund manager and as the investor, is very important. Thank you. Okay. I'm sorry, guys. We're almost done. Okay. And step 3 is we can pitch to investors. So this is Square's pitch to the VC firm that backed them. As we know, when we check out for most of the places that we eat, we're using a Square device. And granted, this is a startup's pitch to a VC fund. A lot of the principles shown here are applicable either way. You're going to have your proposition, which is going to be like, this is our investment strategy if you're the fund that's trying to face investors. And you're going to talk about how you're going to how your investment strategy is going to drive value, drive yield, drive return. You're going to go through your management team. This is something for all of us to think about as we go into our careers, is eventually having one of our names here on a management team, kind of the things that we do and the projects that we work on throughout our life are going to kind of make or break us. It's going to make an investor say, look, John Gillis is on the management team. I definitely want to give John Gillis my money to invest it. Or Alex Azar is on the management team. I want to stay away from that guy. So this is very important, knowing who's actually responsible. You're going to have your financial models and projections, how you think the fund is going to, obviously this is the company, this is at the company level, but you're going to want to communicate how you think the fund is going to perform year over year, and then your exit strategies. And this is going to be super asset specific, but for example, if you're in real estate, you're going to want some communication as to how you're going to dispose of those assets, how you're going to get to that disposition value, et cetera, et cetera. Kind of just for fun, just to demonstrate when you really kind of follow the money and you follow the ownership. We know that pension funds are big. We know that a lot of these sovereign wealth funds have a lot of money to invest. Like of that top 10 list, on the top 1,000 funds website. I think they were primarily all sovereign wealth funds. Does anyone want to guess what fund owns the Newcastle United soccer team, the Shard in London, and the PGA Tour in the US?
Is it the Saudis?
Yes. It's the Saudi Public Investment Fund, and most of the money that the Saudis have to make these investments are coming from oil exports. But just as you can see, when you're driving down the street and you're looking at the real estate, for instance, or when you're interacting with a company, there's a good chance that behind that, the actual ownership of a lot of those assets are some type of fund. And again, pull this from the Wall Street Journal that just is trying to demonstrate that private equity really owns a lot of the brands that we deal with on a day-to-day basis. Recognizably, you can see Burger King is owned by a private equity company, Del Monte Fruit Company, Legoland, Hugo Boss, Hertz Rent-A-Car, Pizza Hut. And again, this entire structure, it's very, very common, it's very pervasive, although not in a negative way. And it's very important to understand kind of the way that these things work and the ownership on a lot of the assets that are out there. And our final slide.
The fund of funds, so there's other funds that will invest in the managers and other funds that they believe will do well in the future. So they're not directly investing into, well, they are directly investing into companies, but they're not going to be directly investing into companies that are actually purchasing and making things. They're going to be investing into, they're going to be the ones giving other funds money for them to invest. And they just choose the funds that they believe in.
Right, so these are funds that the investment strategy of the funds is to invest in other funds. These are the top 5 funds in the U.S. So their assets, they have $98 billion in investments in funds. So, for example, Pathway Capital Management, they invest in private equity. They have more than 30 years of experience as a leading global investor in private equity. They identify and invest in the highest quality opportunities. So kind of the strategies here are going to be identifying the management teams of different private equity companies. This fund, Pathway, has 115 private equity positions, over 1,050 private equity investments made. So you're thinking about kind of, why don't I just make a fund where I'm investing in other funds and diversifying? Well, here it is, and that option is available to you.